So moving on to the US market. Going to follow the same format. First, look at factor analysis and performance of the CPMS strategies, and then market fundamentals and outlook. So July and August posted significant returns for the S&P 500, and then with a slight dip into September. So price change perspective, 8.5% for the quarter. And that was actually 5 consecutive months of positive performance until September. Breaking that down by index, the NASDAQ led the way. No surprise there. Technology leading once again with an 11.2% return, and the S&P 500 posting an 8.9% total return for the quarter. Market breadth across the S&P 500 was great for the quarter at 71%, and then just slightly under half of the S&P 600 with a 47% market breadth. So in Q3, market breadth fell from 92% in the previous quarter to 71%. And looking at that from a sector perspective, it definitely was a broad-based market performance across sectors, with energy just not participating, down almost 20% for the quarter, and only posting an 8% market breadth. So FANG leading the way again, no surprise there. However, L brands posting the best performance at 112%, which I think is mostly just due to the overreaction in Q2 and that stock bouncing off the lows. It's a visualization here of the sector performance, with consumer discretionary leading the way, and then materials not far behind. The 50 best performing stocks in the S&P 500, a significant group of industrials and consumer discretionary here, but overall it's been fairly broad-based. And then under IT, you can see AMD, some of the chip makers, NVIDIA posting huge returns. Some of the worst performing stocks, no surprise. We have a lot of energy, and then a mixed bag from there. So here we're looking at the top 50 stocks and how they looked at the beginning of the quarter, and then comparatively to how they looked at the end of the quarter. And this is similar to what we saw in Canada, where the analysts revised downwards, and the stocks that were rewarded the best over the quarter were stocks that actually surprised to the upside, where analysts were just a little bit too pessimistic. These stocks also tended to have low valuations and weak earnings momentum coming into the quarter. However, they did turn things around towards the end of the quarter. On contrast, the worst performing stocks had market-like earnings surprises. So actually better than the top 50 stocks. They also had low valuations. The difference here is that throughout the quarter, they weren't able to turn things around, and they actually had negative earnings surprises throughout the quarter. Good news, 80% of the time you will make money being invested in the S&P 500 in Q4. And then from a sector perspective, IT also leads the way in the US with a median return of 8.7%, and this is back to 1989. Energy also being the worst performer in Q4. So next, we're going to look at the single factor analysis. So which fundamentals did the market reward during Q3? In the US, there seems to be a constant theme of market cap leading the way. So the largest company is posting the highest return, 10.1%. And then on the contrast there, the market punished high yielding companies as well as price to book being negative 1.5% from price to book being a standalone factor. The CPMS strategy returns in Q3. So price momentum was our top performer at 14.2%, with our D10 earnings value and earnings momentum and asset growth right behind it. The S&P 500, as we talked about, 8.9% return. And then some of our value strategies lagging, with valuation being the worst performer, down 10.7% for the quarter. So value is continuing to get punished. And then the last segment, market fundamentals and outlook. Year over year, quarterly earnings growth is continuing to decline in Q3, but rebounding from Q2. The ROE net of T-bills is projected to rise again significantly in 2021. Year over year earnings still on the decline, but expected to bounce back in Q4 a little bit. And interesting stat, Q2 experienced the worst estimate cuts in 25 years. However, once again, the analysts were too pessimistic, and the revisions snapped back into positive territory for Q3. So 84% of companies in the S&P 500 beat their earnings estimates, 15% missed, with IT and industrials leading the way, as well as actually materials, consumer staples, all posting significant beats within the sector. So the sector overviews, EPS growth negative across the board, flat for utilities. However, earnings surprise is positive across the board, so similar as within Canada. And then other considerations. So the dividend yield on the S&P 500 is greater than the 10-year bond yield, and that gap has decreased since last quarter. Unemployment is rebounding in Q3 from the Q2 extreme. And just to summarize, so valuations are at a sort of middle of the range over the last 7 years. The CPMS median reported ROE has declined 180 basis points since March, but it's definitely projected to rise significantly in 2021. Reported earnings continue to decline in Q3, but they have bounced off the lows in Q2. Dividend yield still greater than the 10-year bond yield, but that gap has decreased since last quarter, and unemployment is expected to drop in Q3.